Well, John here again with another big old update. Today we're going to have ourselves a humdinger. Why do I say that? Because you've been asking for this for some time, and I've heard a lot of people with a lot of concern about this topic, and that topic is going to be what happens next month, John, when we have the election. And when I hear that, most often what I hear in your voice is fear. And some of you might say, well, of course, Sean, I'm fearful. And that's what gives me the energy today to do this presentation. So why is this job so much fun for me? Well, stop and think about it. If you have a concern right now that's really not a valid concern, or if you have a concern but you can avoid the pain by knowing which direction to go into, and I know it, how cool is that for me? So we're going to take a look at the presidential election, what that's been over the years, what we expect it to mean. We're also going to focus on what we can do. And a couple things I want you to think about. I want you to think about last spring. Horrible, horrible time in the market, wasn't it? You had unemployment was sky high in a short period of time. Profits were gone. The economy was just terrible. But the market did what? Yeah, it just took off, didn't it? Well, let me ask you, why did the market take off last spring in the midst of such calamity? Now, if you're my client, you should know this. I've talked about this. There's one reason. Tons of liquidity. What's it mean? Tons of money in the market. The government pumped trillions and trillions and trillions of dollars into the economy. And you know what? I firmly believe, had we not done this this spring, we'd be sitting in a very deep recession or depression right now. And instead, we're out of our recession. So as you look for the election coming forward, think about the difference between Republicans and Democrats. What's one big fiscal difference between those two parties? Or moreover, which party tends to spend the most money? The Democrats. Well, do you think the economy sees that any differently than stimulus? I don't know. We'll take a look at the numbers and see. But before we jump into that, I want each one of you to ask yourself this. This past week, what was a highlight of your week? What was the best thing you did all week that gave you the most fun, the most joy? And whatever that is, I'm going to suggest to you, do it again. My bride and I drove all the way up to Jackson, Mississippi, and we went bike riding on some trails up there for about a couple hours. Stopped at Cock of the Walk on the way home. That was the best part of my weekend. So without any further ado, I'm going to take a look at about 16 slides we got here. They should help you. Here's what I'm hoping to happen. I'm hoping you get the knowledge, make you better off, and gang, believe me, every one of y'all that call me, text me, or email me, hey John, this will benefit, that's my paycheck. That's how I know I'm doing good here. So, hey, if it doesn't hit you, good, don't communicate. But if this is meaningful to you, pass it on to me, and moreover, pass it on to somebody else you think could benefit. Let's take a look. All right, you're watching this, so I know it matters to you, so really, really pay attention. I will tell you that I'm a bit concerned I may be about to disappoint you with some of what I'm going to share you because, quite frankly, there's not a whole lot of bad that I see on the horizon here. You judge for yourself. Well, the stock market performance after elections. After the year after election, the market tends to be a little lower. Bonds tend to do a little bit better the year after election. When a new party comes into power, analysts found that the market gains an average of 5%. When there's a re-election of the existing president, there's about a 6.5% gain the following year. I'll tell you out front, I'm a registered Republican. I'm saying that because I was a little surprised years ago, when I did my initial research probably 10 years ago, that the market tends to do better under Democratic regimes. Look here from 51, Harry Truman won that year, and there was a 23.5% gain in the market, 23.7% gain in the market that year. Of all those years through 2010, there was only 3 years where there was a loss in the market, and the average return over that time frame was 13.2% per year, and the median was 15.6% with Democratic regimes. Again, I think part of the reason for this is there's just so much spending during Democratic administrations. And I guess the only concern there is how do you pay it back, and that's a whole other discussion. Well, here you go. Since 1945, under Democratic presidents, the market's averaged 9.7%, and during Republicans, it's 6.7%. The volatility in the market heightens its way as that time of year. As you go through July, August, September, October, November, there's a lot of volatility or risk in the market. But if you look at the slide, it tends to drop off precipitously fast. This is a good little slide showing what the market's done about 60 days out from the election, and you'll see it's in a kind of a channel, or it's in a sideways motion. And it kind of goes up and down within a range. It's range bound, but by the time the election occurs, the market tends to take off really, really well. Just another slide to show that where, as you see right here in the marketplace, and the market tends in the last quarter, last few months, really to do very well. Primarily the last 9 weeks, 8 to 9 weeks, is when the market will really do its best. I broke this down into 4 different quarters, showing the first quarter is a pretty good quarter. Typically it's 2.2%. That's since World War II. Quarter 2 is not much different. Now the summer is a tough time in the market almost every year, albeit it wasn't this year. So that's what I'm paid for, is to navigate these waters that can be kind of volatile. We had a very good summer this summer, but the fourth quarter, as you can see, since World War II, has really been one heck of a quarter. This shows since 1980 the sector performance and the percent of time the market is positive. So look at here, 78.8% of the time the S&P 500 is positive. Consumer staples, 84.8% of the time. Healthcare, 84.8. Again, a fourth quarter. I'm not trying to, I don't mean to sound overly enthusiastic, but I guess what's happened, I've listened so much to clients and non-clients the last 2 or 3 months, all year, with great worries about this, that it's given me a little vigor to kind of show you why I see it differently. This graph here is interesting. They took out, you see your gray line here is if you take 08 and 09 out, what the market did. The black line is the market overall since 1900 to 2019. And here we are right now in the current year 2020, and you see we've peaked up ahead of the average. We've had a bit of a drop off here recently, but it's worthwhile saying we had the best August in the market ever. So the question becomes, what happens if a particular candidate isn't elected? That's the question. And the answer is there's nothing you can do about that candidate. However, the way we respond and the brain power we use is going to mean some people are going to make money, some are going to make more money, and some might lose money. So if Joe Biden becomes a president, they're going to spend massive amounts of money on green energy, solar panels, which means those would be good areas to invest, wouldn't they? Wind turbines, the real good opportunity. If Biden gets in, it will not be good for healthcare energy. Democrats aren't good for companies like Amazon, Facebook, ICE, which is something I learned from the wife last night. What ICE is? Internal combustible engines. They won't do well, or airlines. So we take this knowledge as we invest your money and my money, and we're just mindful of that. So if we had a Biden presidency, we would be very careful about where we're going to invest our money. Now, what we're not going to do is go buy an investment, a pre-manufactured investment like a mutual fund that has no decision-making process. They buy a little bit of everything. That's going to hurt you, particularly, I think, if we have a Biden election. If President Trump's reelected, financials should do well, energy, aerospace, defense sectors. I mean, he's put a ton of money in defense, technology, consumer goods. Now, what will not do good are investments in China, Europe, emerging markets, and green energy. So the purpose of this presentation is to give you some idea of what to expect. I don't see bad things if either one's elected. There's going to be a humongous difference what we do here at JCN to protect your money, not just to protect it, to make more money. We're doing that every year, every quarter. We want to be picky. We want to be very, very picky when we go invest a dollar. This chart here shows the S&P 500, the whole market from 2010 through 20. And it made a heck of a return. It over doubled in 10 years' time. But what's that tall line doing right here? What's this tall one? Why is it so much higher? It made 900%. Didn't make 200, 900%. Why did it do that? Well, that was Amazon, Apple, Google, Microsoft, and Facebook. Those stocks made that much. That's why you have a portfolio at JCN. If you're in a growth portfolio, we only own 12 stocks. If you're in a value strategy, we only own 20 stocks, because we know that if you own more than about 30, you cannot expect to be able to beat the market. We started talking back in the summer about charts, about Hirsch signals, and how we use those here and why they're so important. And a Hirsch signal is one that measures the crowd. So as more and more people are buying and buying and buying, when you start off right here And as you get all the buyers that are going to buy, there's no more room for the stock in the market to go up and it'll fall. And we talked about this in the summertime. We didn't want to buy Apple for a long time. It was too expensive. People were buying it when I wasn't buying it. They were overpaying for it. And we got a 99 on the Hearst extension. And I made a presentation. Olivia can give you the video to go back to. I said, this is a good sign. We think Apple's going to drop. And Apple dropped a whole lot. And we bought. So here's in 720, this graph here shows where we had an extension in the market itself. The whole market had an extension on it. We sold 10%. We're in the business of nickels, dimes, and quarters and taking small steps. So we're not going to take a big, bold, aggressive step. But we took 10% of your portfolio and we realized a profit and we put it into a dry spot. And then we waited to get an extension on the bottom end, and we got one. And you see, we just recently invested yet again. So, y'all, that ought to be pretty cool to you, shouldn't it? Because that's a good example of not just buying low and selling high, but it's how you do that. And we do that throughout the course of the year, every year. So, to sum this up, I'm not here to pat you on the back and tell you everything's going to be okay. I'm here to show you what the game plan is, how we're going to manipulate it. And you should be able to determine whether you're okay. If you don't know, you're okay. If you're not sure you're okay, give me a call. I'm not in a position of convincing you into a fantasy. I'm going to show you what the data is. When we have bad data, I'm going to say this is really bad. And when it's really bad, I'm going to say this is what we're going to do. That puts a smile on my face because it's how I actually am able to help you. So I hope this presentation made sense to you. I look forward to hearing from you, and we're going to follow up with quite a few more between now and the end of the year. If you haven't called me about a Roth conversion, you probably should call just to make sure that it's not something you should be doing. We're getting into range of time, but we want to take advantage of that as we can. If you're not a client of JCN and you're watching these videos and it raises some concern or maybe some opportunity, or you just would like to know a whole lot more, how does this affect you? What can you do? What are you doing right? What can you do more right? Or maybe most importantly, what are you doing wrong? I invite you to give me a call, 225-755-0488. Be glad to meet with you. It's complimentary. I can meet with you on my computer or face-to-face. John Neyland, thank you to my wife Karen who videotaped this today. And I'll see y'all soon. Bye.